It certainly has been a surprise that rates have come down this much because, as a portfolio manager and an economist, I can tell you that longer term interest rates are really driven by fundamentals. And those are including two things. One, inflation expectations. But a second thing, the second part of the interest rate, it depends on real economic growth. Now, clearly, we're in a period of particularly high economic growth as we emerge from this COVID-induced recession. But even longer term, if you look at global growth, 1.5%, 2.5%, we should expect even after the initial phases of recovery for growth to stay elevated because recessions just take a long time to unwind. And so, that suggests to us that what we're seeing in interest rates is a rush to safety, right? As some of the risk factors have become elevated, whether it's COVID, whether it's the G20 meeting and the talk recently about raising corporate taxes around the world in developed countries. Those are two important risk factors that I think are perhaps right now driving investors to safety. And when we talk to clients, we hear those fears, as well as fears about inflation eventually coming back up again. So we do expect that rates will eventually have to reflect those two key fundamentals, higher inflation and also the real economic growth that's definitely out there and is likely to continue at elevated levels for some years now.
Well, isn't that the paradox, Joanne? Because we want good economic growth. You need me on that wall. We want all these things, but we don't want them too good, right? Because too good means massive inflation, shortages, wage pressure. Where are we right now? Is it as good as it will get, or is it sustainably good, or is it dangerous from an inflation perspective?
Yeah, I don't think it's so dangerous. I mean, we're certainly seeing the shortages that come from a quick restart of an economy when supply chains are still somewhat, fragmented because of what's happening with COVID around the world. But we are seeing a pickup in manufacturing. We're seeing a pickup in productivity as labor, is slow to come back to the workforce. The way we see it is we've gone through phase one of the reopening. That was the initial reopening here in the United States. We're looking now into phase two, which is going to be, we think, the post-Labor Day return of the workforce. Kids are back in school, those extra unemployment benefits run out, more vaccinations in the U.S. We do expect that second phase, and that's going to, not lead to a pickup in the growth rate. Obviously, the year-over-year growth rate is as high as it's ever been and ever going to be. But then we also look to phase three of recovery, which is when the international recovery really takes hold. And for that to happen, we need those vaccinations to ramp up around the world. So when you look at the investing environment, when we're selecting individual stocks for our clients, we're actually building in more international exposure now than we did before, because we do think that phase three is going to be a nice afterburner to the recovery that's starting here in the United States.
That's a theme I've been reading a lot about in, notes coming out, macro notes from big banks and whatever, is that Europe may be a few months behind us, but that in vaccinations and recovery, but that may make Europe a better bet in the markets than the U.S. What would you say to that, Joanne?
Well, I think there's definitely room for that, but you also see there are also some risks associated with that international exposure because, vaccinations have just really gotten underway there, and it's going to take a long time. And, the U.S. economy is a far more flexible, agile economy, so we're, I think, going to do better at the bounce back. So you want some international exposure, not just Europe, but Asia and Latin America, where they're also really struggling with COVID. But, in the U.S., you also have plenty of companies to invest in that are multinationals, whose customers are spread out all over the world. So when we look, we find it's a really useful thing right now to include some of that international, and investors may even want to have a separate account that's purely international. But we find smart cyclicals a place to be, technology for growth, and also some dividend as well as international exposure. And that's what we're building. That's what we've built into client accounts already, and we continue to focus there.
Shepard Smith here. Thanks for watching CNBC on YouTube.